Hi everyone, in today's video I'm going to share with you some of my investing tips. Coming up. Hi everyone, this is Ernesto from Attaboy Cowboy, and this channel we give you health and wealth tips to help you be successful. Now, I've been getting a lot of questions lately about investing. People want to know, hey, what do you invest your money in? Well, I have a lot of experience investing because I've had a lot of ups and downs, and that's part of it. You're going to have a lot of losses, you're going to have some gains. At the end of the day, you just want to make sure you're ahead. So the first thing I'm going to talk about is stocks. Now, I have stocks. I've invested a lot in stocks, but no, the stocks are one of the most risky investments you can make. I don't really recommend stocks because I have a master's in economics, an MBA in finance and marketing, etc. And I read a ton of books, and it's still risky. And I lost a lot of money in it, and other people lost a lot of money. So unless you have a lot of time to invest to it, and it's your full-time job, I don't really invest in stocks because it's not a good strategy for investing. And I'll tell you one of the main reasons why I don't. People look at the Dow Jones and the NASDAQ and all this stuff, and they see it going up and down. And I remember in business school, we went over all this stuff over and over and over. And at the end of the day, I asked my professor one time, I said, this guy was like world famous. He did all kinds of stuff. He wrote like 40 something books. And I said, hey, what is it that makes the market go up and down? And he goes, what do you think? And I said, emotions, fear. So at the end of the day, it's very subjective. You can't control a lot of this stuff. And I'll tell you a few of the things that happened to me. I remember I invested in this company that made equipment that scanned mail. Because here in the US, they had just started shipping like dangerous chemicals to the mail to do terrorist attacks. And this company just took off, man. I mean, it tripled like in 2 days. And I thought, wow, I'm great. I'm so smart. I made all this money. Guess what? In 2 days, the Postal Service came out and they said that they were going to use some other product. That company just nosedived, and it wasn't worth anything. I lost a ton of money on it. So one statement, boom, was gone. And I can share a lot of stories with you like that. And if you ask some questions about that, I'll go into that more in details in other videos. But it's just too subjective. Anybody can say anything. A president, a movie star, Elon Musk. I bought Tesla stock. I've gotten nailed because he comes out and he says crazy stuff and the stock just nosedives. Another thing that I don't like is big market movers like annuities and pension funds. They're allowed to do legal insider trading. Now, if you've ever heard that insider trading, people like Martha Stewart and some of these other famous people, they've went to jail over it. That's when you get information before the public does and you act on it to make money. An example of that would be, okay, let's say Apple just blew their sales forecast for their new iPhone. They sold twice as many, but they haven't announced it to the public yet, and they're about to announce it like in 2 days. The employees obviously know that. Now, if they go out and they buy a bunch of stock and then announce the information, the stock doubles, and then they sell it, that's cheating. It's called insider trading. That's not legal. But big pension funds are allowed to do that. And they're the ones that buy most of the stocks in the world. Now, just to give you an idea, STRS, which is the State Teachers Retirement Fund in California, has so much money that they have invested because they use that to pay their pension teachers. They own 20% of the French economy. Just to give you some perspective, that is the pension fund for California. They own 20% of the French economy. That's huge. They have huge investments around the world, so they make huge impacts. So if they decide they're going to buy Apple stock or sell Apple stock, that's going to have a big effect. And they're allowed to legally do it with inside information. So that's kind of like cheating. but it's also a benefit. If you decide you want to do stock, you want to look at the volume of stock being bought and sold. Look at it, and when you start seeing massive volumes of stock being bought, that's when you jump in and you buy it, because that means a pension fund is starting to come in. They don't go in and buy 10 million shares of Apple. The stock would quadruple one day and they would lose a lot of money, so it would go back down after that. So no, they slowly start buying over a period of time. That's how people figure out when it's a good time to buy something or to sell, when you see large volumes of sales. So it's kind of a complicated process, and on top of that, there's technical issues. I once took a loan on my house because I wanted to buy another investment property, and I had like $200,000 sitting there, and I thought, man, what can I do with this? I was in escrow for this other building, but I had this money sitting there and I wanted to make some money off it. So I said, okay, I'm going to do something with it. So I put it into some stock, and I was shorting, it's called, some oil stocks. And if anybody knows what shorting stock is, it's kind of like, let's say you buy something that's $100 and you know it's going to go down. So you're kind of buying it assuming it's going to go down, and you're going to make money off the losses. So if it's $100 and it goes down to $50, I'll actually make $50. Or if it goes from $100 down to like $80, I'll make $20. See, so you're kind of doing the inverse. It's called shorting. Regular stock, you're buying them at 100 and you're hoping it goes up. If it goes up $10, you make $10. The shorting is risky. So it's kind of technical. I was using this program on the computer, because a lot of it is online trading now, and I forgot to click a tab, and this tab is called your limit price. It's the price that you will not sell below. So I wanted to say, for example, I bought this stock at $100 and went up to like $120, and I was trying to sell it all at $120. Now I took the money on what's called a margin call. A margin call is like a temporary loan. So let's say I put $200,000 in, the bank or the brokerage will lend me another $200,000. So now I have $400,000 to trade. As long as that doesn't go below that $200,000 that I have, I'm okay. But if it goes below the 200, they give you what's called a margin call, where they want their money. They'll sell whatever you have, take their money, and then, hey, you owe us the difference. Whatever is below the 200 they borrowed from you. So that can be dangerous. So I was on a margin call. I had borrowed double the money. So let's say I had $400,000, and I was trying to sell this stock at 120. It went up from 100 to 120, right? I forgot to click this button that says limit, which says I will only sell it at $120. If you don't click that and you're selling a large volume, let's say $400,000 worth of stock, you'll immediately make one of those little dips. You know, like when someone's on a heart monitor, you see it going up and down? Sometimes stocks do the same thing. If you look at their price during the day, you'll see it going up and down. I made the price of that stock tank from 120 down to like $1, and then it jumped back up like in seconds. Long story short, I lost $175,000 in 7 seconds, and I knew as soon as I clicked that I'd made a mistake, and I was trying to do all sorts of stuff clicking. I couldn't do anything. Game over. I lost all my money in 7 seconds. Now, that was all the money I had in the world. That was the only house I had. It was a lot of money for me. I lost everything in 7 seconds. So it was a really unfortunate situation, but I learned a lot. Don't mess around with large quantities of stock like that, and be careful when you're doing those margin calls and margin lending. It's very dangerous. You lose all your money. I ended up having to pull out of escrow on that house. I couldn't buy it. That affected me for years. I actually had to pay that back for 10, 15 years. It was a huge mistake. So avoid those types of situations. Now, my favorite strategy for investing now is startups. Now, this is something I've been learning about the last few years. I've been reading a lot of books on. It's a really interesting thing to invest in. And you can actually use your retirement accounts, your IRAs, your 401ks, your 403bs to invest in startups through funds. Now, startups are basically new companies that are starting up, and they need seed money to grow. So a lot of these new tech companies like Google, YouTube, Uber, Facebook, you name it, they all started up as a startup. So they needed money. If you ever seen that movie on Facebook, they start in their garage, or Apple, they start in their garage, and they want to grow their company. They have a great product. So you can really make a lot of money about that. I remember when I watched the Facebook story, they were talking about how a lot of startups don't have money. So I have a friend, actually, I'll tell you about him. He worked for a company called Bird. It's electric scooters. He was getting his MBA at USC, my alma mater. And he dropped out to work for like a series of startups. They all went bankrupt. They paid a minimum wage. Minimum wage in California is like $10 an hour. If he went and got a business job and finished his MBA, he'd be making like $50 an hour or more. But he was making minimum wage because he wanted to simply work at these startups. And what they give him in exchange is they give him shares of stock and shares of the company. They actually gave him 0.25% ownership of the company. Now, that doesn't sound like a lot, but in 2 years, he told me the value of that company, Bird, jumped to about $2 billion. So he told me that in 2 years, 0.25 of $2 billion, if you do the math, it's about $5 million. So in 2 years, he basically had $5 million of ownership in his company. So that was a great investment for him, I guess, to drop out of school and work at the startup. Now, I'm not necessarily interested in working at the startup, but because I don't have a lot of the skills that they probably want. Or I may in some cases, but you can invest in them. You can avoid doing that. So some of my favorite sites, if you look on the internet, there's a ton of them. But some of the favorite ones that I use is WeFunder, and I'll put the names of these companies on the side. And WeFunder is great. You can start off with companies that are really young. You can do investments as small as $50, $100, $500, $1,000, whatever you want. And you can read about the different companies. I particularly like tech stocks and environmental stocks and alternative energy stocks, but there's all kinds of stuff. There's makeup, there's alcohol, there's social media sites, there's all kinds of stuff. You can read the profiles, you can read about the people running the company, you can read their curricular vitae, which is really cool, the resumes. It tells you what kind of experience they have. Really interesting people. And a lot of these companies, if you invest a certain amount, you can actually have conference calls. You can get invited out to the company and check out their company. They can explain to you how they work, their plans, everything. It's very, very interesting. You can get a lot of good information. It'll teach you about it. Another site I use is kind of mid-level. So WeFunder would be like for starters. They start like at $50, maybe even less. The next site I use is called Plungers Club. That one starts at about $2,000 or $3,000, and those are like companies that are already on their way. They're like in the middle, and they're already pretty successful. And what they give you in exchange for these investments, I'll give you an example. I just bought $1,000 worth of shares in a company on WeFunder, a new company. What they gave me was $100,000 worth of stock in the company that are worth 100,000 shares worth $1 each, so $100,000. You're saying, wow, why would they give you $100,000 worth of a company for $1,000? Well, because, good question. A lot of these companies fail, to be honest with you. So there's a chance you're not going to get anything. You're going to lose all your money, and they know that. So it's high risk. So they give you something that's valuable in exchange for your money. They can give you percentage ownership of the company, they can give you shares, or they can give you stock, or they can say, hey, it's kind of like a loan. Like you give them some money, give them like, let's say $1,000, and in 3 years we're gonna give you $2,000 or $3,000 or $4,000, whatever. There's all sorts of different agreements. You can read about them on there because they're particular to each company. But I'll tell you why it's still a good investment. 1 out of 10 startups that you invest in are going to succeed. That means 9 out of 10 fail. That's actually pretty good. So 1 out of 10, you're going to get your money back. So let's say you put 1,000 into 10 companies, you're going to get $1,000 back out of that one. But 1 out of 100 is called a unicorn. Now, a unicorn is what you would call a Facebook, an Uber, one of these companies that just explodes and is all over the place. Now, those companies, I was just reading about a guy a couple days ago that invested $1,000 in Uber when it was a startup, and his investment is now worth over $20 million. So some of these people that invested in Facebook, that invested like 1,000, their investments are worth tens of millions, sometimes over 100 million. In the Facebook movie, you remember they were giving shares of the company to all the employees when they went public from one day to the next. Everybody, janitors, gardeners, everybody, they were multimillionaires in one day. So those shares are really valuable. They can be worth a lot of money. So if you think about it, 1 in 100 is not a bad risk. It's actually very good. If you've ever bought a lottery ticket, that's a complete waste of money. So that's not an investment strategy. My dad loves lottery tickets. He's bought lottery tickets his whole life. Don't buy those. Those are you have a greater chance of getting hit by lightning than winning at a lottery or a bingo. Oh, not a bingo, but a lottery ticket. So instead of doing that, invest in a startup, which is about a 1 in 100 to get a unicorn. Now, let's say you invest 1,000, for example. 100 is 100,000. You could even do $100 in 100, and that's 1,000. That's $10,000. Or you could do $10 in small companies. And that's $1,000, right? One of those is going to be a unicorn. If you get one unicorn, it's going to give you all your money back. So it's actually really good odds. The thing is, they're not real easy to cash out. So the advantage to having stocks and bonds and stuff like that is if you get in a pickle, you can get the money out right away. You can use it for whatever if you're in an emergency. But with startups, it's not so easy. You're usually investing and your money's going to stay there for a few years. And they're not going to make it easy for you to cash out. You can sell it to somebody else or something like that, but they're not really made for that. They're really made for you to park your money in there and just leave it there for a few years until the company blows up. And then you could get a lot of money on it. So startups are really good. So those are the first two sites. Now, the third favorite site I like is called Equities. Equities is companies that are already making it. They're startups that are right before an IPO. IPO means initial public offering. That's when they're already going to get publicly traded. They're going to become a stock. And those are worth a lot of money. That's where you make a lot of money. So you definitely want to get in before it becomes publicly traded. That IPO is what you want to do. You want to get in before there. So Equities, I was just checking on there a few days ago, just to give you an idea of some of the companies that were on there. I saw Airbnb, I saw Postmates, I saw Instacart, I saw the e-cigarette company called Juul, Juul. I think I mentioned Airbnb. There were big names. I saw Wish. There's a company called Wish that's it's kind of like a website where you sell stuff, you can buy stuff on discount. And it's a really popular site, but it's not publicly traded yet. So you can invest in them. Now this website is for people that have a little more money. These requirements are usually about $10,000. But these are pretty much guaranteed investments because these are companies that have made it and they're looking for just enough extra cash to be able to do an initial public offering. Now, initial public offering is when you sell stock on the stock exchange. That's where you make a lot of money. So Uber recently just went public. That's when they go public, is when they sell their stock. They needed to have a certain amount of money before they can go public. So they needed money. So they were actually on Equities then. And if you invested, I don't know, $20,000, let's say, or $10,000 or whatever, you can invest $100,000. You can invest large amounts of money there. you're pretty much guaranteed to get a large return on your investment. And what it is let's say Uber is worth, let's just say they're worth $1 billion. And to become publicly traded, they have requirements. You have to have a certain amount of capital and cash on hand. So they need to have money in their bank account just so they can qualify to sell stock. So just to make the example easy, they needed, let's say, another billion. So they sold shares of the company, preferred stock they're called, and they raised another billion through Equities and other websites. Now they got to 2 billion. Now they're able to trade their stock. They get listed and trade their stock. Then they get listed, they sell their stock. Guess what? They sell enough stock. Now they're worth 30 billion. So now they have another 28 billion as an example to use to grow that company, spread Uber all over the planet. So that's kind of how it works. They're looking for money to grow their companies, you know. Remember, no matter how good your idea is, people still have to hear about it. So they need money to develop the product, to market it, to get people out in the street trying it. I mean, it's a huge investment. So there's a lot of potential there for earnings. You can make a lot of money in that. So I strongly recommend investing in startups. Try to avoid stock and go into startups. You'll have a lot more success. Thank you for listening. If you have any questions, please comment below. This is Attaboy Cowboy from downtown Los Angeles. Thank you.